With that, let's go to the next chapter on operational risk. Thinking and investing operational risk. So with this, we'll just start defining some of the operational risk. Now we have basically in from a risk standpoint, there are four kind of risk. One is a market risk. Now, it was very difficult to identify and say which of them is an operational risk because market risk is the risk that comes with the change in the movement of the market price of any security. Credit risk is still gaugeable because if you're paying money to anyone or you are receiving money from anyone, what is the kind of credit risk that you have? And that depends on the ratings also, which can also go up and down. Liquidity risk, on the other hand, ensures that you need to have enough money to honor your commitment in terms of liquidity, which is also understandable. Operational risk was something which was highly non-classified and there was definitionally very weak operational risk. To circumvent that problem, some people usually define it as clear area where things are not market risk, credit risk, or liquidity risk. They used to call it as operational risk. But then, Basel norms started defining it more clearly by calling it, and this is by far the most closest definition for operational risk as we can see. It says the risk of loss resulting from inadequate or failed internal process, people, system, or from external events. The risk of loss resulting from inadequate or failed internal process, people, system, or from an external event. So first thing is, it is the failed internal process. If you're not putting a security guard in front of your building, that's a failed internal process. People, if your household is basically stealing from you, that's a people risk. The system risk is that your systems are not performing. You have an alarm system or you have a camera at home which is not working, so the system is weak. Okay, that is all bringing into or combining that under the operational risk. Within operational risk, let's say we classify things into 8 standard, like this Basel Committee's framework, which helps us most closely define for this, has come up with 8 ways or eight different things here. One is called as an internal for 8 different areas here. One is called as an internal fraud. Another is external fraud. The next one being employment practice and workplace safety. Then we have client products and business practices, damages to physical assets, business disruptions and failed and system failures, execution, delivery, and process management is the seventh one. Now, what does it mean? Basel Committee gave you 7 buckets. If you look at it, these are 7 buckets, 7 highly comprehensible buckets. And then there are other losses which were identified later as well. So let's go through each of them. One is called as a Basel Committee. Which has a basic bucket of 7 different things. One is the internal fraud. If let's say what happened with the PNB bank, where people were not doing it, where the people were not, filing the documents properly and doing things. It's a case of an internal fraud where the employee was also a participant in what was the wrongdoing. Okay, that's a case of an internal fraud. If you're doing like what do you call as insider trading and all, that's also a cost that is also sorry that also qualifies as an internal fraud. Now, external fraud is something wherein a person may be using your resources to do something else. So, if I use my company's laptop tomorrow to do, to work for another company, that might be a case of an external fraud. Then there's employment practice and workplace safety, which is taken very seriously now. So it is like in earlier Hindi movies and all, you might have seen people losing their hand or leg into a machinery because the workplace safety was not there. Even in construction business, it's very common to focus a lot more on the employee practice and the workplace safety because they know that there could be electrocution, there could be ceilings which can come down while things are being constructed, so on and so forth. So people pay a lot of attention here. All the point that we have fire alarm systems here, we have people sitting, you have assembly points here, are a point where we focus completely on the safety aspect. So that is some way which is taking care of the operational risk which exist. Sorry about that. I've just not been keeping well. So Yeah, so let's continue with the discussion. The client products and business practice. This is another thing which you need to know of. Clients, products, and business practice. Like, clients, products. An example of product could be Maggie, because it was found to have unhealthy lead a few years back. Then this was deliberately they were doing it, which is causing a risk hazard. Business practice is something like bribing. If you're bribing someone, that's a kind of a wrong business practice. It happens on clients also where soft incentives are given, like the medical representatives in India pay the doctors heavily to recommend their medicines. So that happens on a client's operational risk as well. Okay. Mishandling of confidential information, breaches in fiduciary duty, money laundering, or also an example of business practice kind of a risk. Now, damage to physical asset has happens because of natural disaster or rioting or whatsoever. And that is where huge complexes always have a high security team. They have cameras, they have ambulances on a standby at any point of time. They have a huge security team which guards that you know building heavily. So damages to physical asset could be a cause of a operational risk which they need to take care of. It could be including terrorist attack, earthquakes. Naturally, your security team won't be able to do much in case of an earthquake. And of course, for fires, for evacuation. Business disruption and system failures, which happens on a and I would say, happens with hardware and software related things like your system going down, your laptop's not working, your server's not working, your connectivity being down, internet not working, is all a kind of business disruptions and system failures where things go as an operational risk because you're not able to perform as efficiently as you would be doing it otherwise. Then we have execution, delivery, and process management risk. Now, of course, we know that a lot of times the wealth managers need to have agreements in place or what is called as the IRA. Getting to understand clients' upcoming liabilities, his risk preferences, and everything. If you don't have right kind of documentation in place, if you paste like Aadhaar card or your Aadhaar card information is not right, you don't have a nominee in place, so on and so forth. The process lags there or lack of documentation delivery is something that can have a long-term effect as well. So this is a kind of an operational loss where if you have a wrong account number for your nominee after your death, the money goes to a different person. So all these is example of the kind of an operational risk. A simple kind of an operational risk which anyone would have conducted in his career is counting the wrong number of zeros. So if you're given a 1 million figure, some people write it 10 million, some people write it a little less. So this is the most common Excel error. If figures repeat themselves like zeros or probably 99999 how many times a nine should come? Most common era which I have seen in my life. Then when it comes to large operational risks, which have now kind of upcoming, which are not standard the definitions, is this definition is actually was conducted once in 2011, and now we are 12 months down the line or 12 years down the line, and that definition you understand might not be the same because things have evolved. So what's the larger definition here? It includes for three other types of risk. One is a cyber risk. You might have heard about people who were getting into the systems, stealing all the data from the companies. And then giving them a crank call saying, if you want your data back, you pay me something amount, X amount in the Bitcoin. Or let's say phishing, where people use a lot of your personal information from LinkedIn, Facebook, and everything, try to correlate that together and use it against you. That's a kind of a phishing. So these are all examples of the cyber risk. Then there are compliance risk. Compliance risk can be which result the organization will incur a fine or penalty as a result of intentional or unintentional failures to follow law and regulations. For example, one of the banks that I know of, they were overcharging their clients over a period of a year, not 1 year, I would say multiple years. So if they were supposed to like bill them 1 million, they were actually billing them 1.5 million over many years. And once they were caught, they had to pay back the whole amount to the client back, plus a lot of loss of trust has happened, loss of reputation has happened, a lot of fines and penalties were imposed on those banks as well. So these are a uh, uh, a thing of compliance risk. One few examples they have given is example includes 1.9 billion five levied on HSBC in 2012 due to lack of adequate anti-money laundering practices. That is where, coming from the banking background, you understand how why people rely too much on the KYC norms. USD 8.9 billion payment by BNP Paribas to the US government as a result of transacting with sanctioned countries. So you have a list of sanctioned countries, and the US dollar 2.8 billion fine levied on Volkswagen on cheating in the emission test. Are all the examples where they were expected to comply with certain things. They took a shortcut, and that is what led to a huge losses for them. And the last of this category is a rogue trader risk. What's a rogue trader risk? So once you do the, once you have, oh, I assume you guys have already done the form book. There is a chapter which talks about all the macroeconomic events, or rather the crisis situations that there is. Give me 1 second. I'll just tell you the exact chapter name as well. Book one. Yeah, learning from financial disaster. Learning from financial disaster. So this chapter specifically, sorry, where is my yeah, this chapter on the learning from financial disaster talks a lot more about rogue trader risk. Now, who are the traders? Traders are basically the people who are given a lot of money by the banks on by the beginning of their day, and banks expect them to be a market maker and get into trades and make bank a lot of money at the end of the day. So they are the ones who are trading on behalf of the bank, making them profit. So every day in the morning they get a lot of money. They need to invest, and by the end of the day they need to return the money to the bank or keep it overnight as well. But they need to make bank a lot of money. So that's where their role as a trader comes into picture. Now, of course, traders are incentivized based on the money that they earn for the bank. So if they are given 100 million by the end of like by the beginning of the day, and they can convert that into, let's say, 100 million into, let's say, 500 million by the end of the month. Within just 30 days, they've converted 100 million into 500 million, which is five times. So think of it this way: because they've made so much money for the bank incentivizes them. So in a way, these traders are basically incentivized for risk taking. And highly incentivized, I would say. They have a very huge paychecks there. But the point here is, if they start making losses, then what? When they are incentivized on making profits, that's fine. But when they don't make enough money for the bank, then of course, due to pressure or pressure and bank, you know, banks, job security, and everything else, these traders become rogue. That is where they start cutting corners. That is where they start manipulating either the numbers or the systems, or uses malpractices in the trading, so on and so forth, so that they can cover for the losses. Now, the point with trading is that, or traders risk is that, usually if they start making you losses, that spirals down, right, over a period of time. And when they spiral down, like when it is like 1 million loss, the second day it becomes 2 million, day it becomes third million, fourth day it becomes 4 million or 5 million. If the losses go deep in an attempt to save their job and things, they start doing malpractices to cover for these losses. Sometimes they misreport as well. All these things are a part of a rogue trader risk, and the banks usually weak operational systems allows for these traders to operate. This is the most fragile area for any bank for an operational risk, and that's where the huge penalties since the beginning of the banking era has been imposed on the trading world itself. A lot of fines, lot of incidents have happened in the traders world only. So this is a single source of most risk for the bank, and the penalties there are also very very high. Two of the examples which they have talked about and also talked about in the other book is Nick Leeson's West Barring Bank example, which led to a penalty of which led to 1 billion loss for the bank and collapse in 1995. Then it is euro 4.9 billion loss suffered by SocGen in 2008 due to the activities of Jerome Carvel. Other rogue traders involved were in UBS in 2021 and Allied Irish Bank in 2022. The point being, rogue trading is or trading itself is a very, very huge risky activity. As you read through the other chapter on the financial disasters, you will come to know about how these things have really impacted banks and made them fragile and cost them a lot of fine money to the regulator. With that being said, let's close the session for today. We are left with still this part on the operational loss and how we construct the loss distribution per se, the power losses insurance.
So in our last class, we have started with this chapter on operational risk. The first half we discussed about, what is a basic definition of operational risk, which is basically a residual of whatever you cannot clearly identify. But Basel tried to come up with a very broad definition for it. With that being said, they identified seven different key operational risks and some other risks which are kind of new in that respect is cyber risk, trading risk, and compliance risk. That is what we have talked about in our previous class. This class, that's where the topic starts. That what is the operational risk regulatory capital requirement? How do you cover for it? How do you establish what should be the amount that you should keep to safeguard yourself for the operational risk? And that is what the next topic is all about. So we start at, the regulatory capital requirement, regulatory capital requirement for operational risk. That I can break it down to basic indicator. Okay, so there are basically three approaches. The first approach is a basic indicator approach, which was very, very easy. The problem with this approach was that it called out for a very generic formula, which might differ from bank to bank. So, for example, there are two banks like Deutsche Bank and SBI. Both are structured as bank. Both are global banks. Global banks, in a way, both have operations in more than one country. Now, we know by far that SBI is far more conservative, whereas Deutsche Bank is far more aggressive. And to keep certain capital requirement as a standardized limit for them, or with some basic formula, is going to be very unfair because we understand that the risk appetite for different banks and the risk model of these two banks are very, very different. One being conservative, they actually need lesser capital to buffer themselves. But the one who's taking more risk, the one who's more into trading activities, leveraging derivatives and everything, will have to have far more cushion cover for any kind of risk. That was one of the requirement, and that also goes for operational risk. Yeah. But yeah, the basic problem was basic indicator was too basic. It says blanket formula doesn't work. Then we came to the standardized approach. the standardized approach. The standardized approach gave some framework in terms of categorizing different kinds of risk. And based on those different kinds of risk, you can of course, clarify that if your risk coming from certain sections is more than the other ones, and these are going to be basically the seven sections that we have, or like the bank divisions that operate. So think of it, if I'm talking about, most of the risk for Deutsche Bank is coming from their investment banking department, then I should basically keep more weightage to the investment banking department. Whereas for SBI, if it's mostly retail loans, then I should give higher weightage to the retail loans in terms of assessing my capital risk requirement. Sorry, operational risk requirement. The third approach, which was more complex, was the advanced measurement approach. It was found to be so complex, and it was merging. It is one step even ahead from the standardized approach. It was found to be so complex that banks virtually found it very time consuming and very difficult to implement it. And for the ease sake, that is where this approach was finally striked off and was replaced by something which is called as the standardized measurement approach, or the SMA, which is a different method of approaching the same level of granularity that they were attempting for, but in a different manner. So the point here is, this basic indicator, standardized, and the standardized measurement approach are lying in the order of their complexity, where basic indicator is the least least difficult of these. Now, what does this basic indicator approach say? So basic indicator approach says that to come up with any kind of a basic number, you need to take average. Sorry, you need to take a certain average. What is that average percentage? Yeah, you need to take 15%. So first of, let me write it here. Basic indicator approach. Basic indicator approach. Okay. So the basic indicator approach says that you need to take a 15% of the average 3-year gross income of the bank. Now, how do we define a gross income? We know from the banking background that the gross income for a bank is basically the NII income, net interest income, and the non-NII income. So non-NII income can be servicing fees and everything. But the NII income is the difference between the interest that they receive on the loans that they have given and the interest that they are paying to the clients who have deposited their money with the bank. On one side, bank is into two-side interest rate business. One side, they're charging people for the loans that they have given to them. That is a higher loan, that is a higher interest rate. And on the other side, they are paying the interest rate to the people who have deposited their money. So we know that the difference should exist, and that is what is counted as the NII, whereas the non-NII is mostly the servicing fees. which is being counted. So for any bank, we need to take the average of the 3-year income. Let's say the first year income is 100, second year income is 200, third year income is 300. And if we take a gross income of that bank, 3-year annual gross income, that would be 600 by 3 is equal to almost 200. And then we multiply this 200 with the 15% to come up with the capital requirement as per the basic indicator approach. The catch here is if there is any value which is negative, because the gross income for a bank could be negative also, since this component is NII, net interest income, right? So if it is happens that due to some kind of interest rate or anything, this value is actually negative, if it and it can be. If that is the case, then you ignore that value completely and you proceed with the rest of the information to calculate for the 2-year average, in this case 250, and then we will multiply it by 15% to come up um, with the capital requirement as per the basic indicator approach. So that's our first approach. The second approach that we have, also very, very cool. So the second approach says that for any bank, the bank has 8 lines of business. It could be corporate banking, trading and sales, retail banking, commercial banking, payment and settlement, agency, asset management, and retail operations. And these are the banks. These are the operations for any particular bank. And for every component, they have assigned a percentage, right? So in this case, where we were taking a 3-year gross income for the whole bank and then multiplying it with 15%, think of it, we'll have to take a 3-year gross income for each of these divisions, come up with an average gross income, and then multiply this with the 18%. Similarly, we'll come up with the 3-year gross income from trading and sales activities, then multiply it with the 18% here. With the 3-year activities, come up with the average retail banking revenue, multiply it by 12%, so on and so forth. We'll keep on doing it, and the end, whatever we get is basically going to be a sum total of all these 8 components. Okay, in a way, this is purely following you know similar approach where we are averaging things and then multiplying it with 8%. So let's read through the book on this. For a standardized approach, banks similarly calculate gross income but uses the 8 lines of businesses to calculate the percentage capital charge, right? Whatever calculations we do, we are calling that as capital charge. With this amount, capital factor of each business line is multiplied by gross income amount of over 3-year period. Sorry. The results can then be summed up to arrive at the total operational risk capital charge, which is being shown here, right? Again, something that you need to just know of, nothing that is there that will come for calculation, neither will we are required to calculate for this chart and everything. The next approach, or let me give me 1 second, let me try finding out a calculation if there is standardized operational risk management. I'm not finding good example. Anyways, let's come to the third approach, which was there but it wasn't worthwhile, and that's where it was scrapped. Right, this third approach is, first I'll talk about advanced measurement approach. Advanced measurement approach. Now the problem with this approach was that it was found to be too complex, because here it says, whatever 8 divisions that you are coming across, like the business lines, which are 8 business lines here, as mentioned, you'll have to come up with seven different VARs, right? Which were based on the 7 kind of risk that we have understood earlier. So there were these 7 kind of risk, internal fraud, external fraud, employment practice, client product damage, business disruption, and execution delivery. So in a way, we were expected to find 8 calculations here, 8 into 56 calculations overall, and then we sum it up to come up with the risk number. That was the basic problem with this approach. So if you look at this, it says that there was 56 different combinations for a 1 year losses into 7 different categories and was introduced by European Union. Sorry. Yeah, here. In order to use AMA, banks must satisfy certain requirement in addition to being approximately unexpected losses is equal to 99.9 percentile of the loss distribution minus expected operational loss. So it was a complex thing to come up with 56 calculations by keeping in mind the VAR number of 99.9% as well. So that is where it was kind of scrapped because it was found to be too difficult to implement by banks also. Then this was basically replaced by another approach, which we called it as standardized measurement approach. Standardized measurement approach. This has a very, very different way of working. Okay, this requires some attention here. Okay, so this approach says, the standardized measurement approach says, see, we are going to follow a very basic formula. The basic formula is going to be BI component multiplied by your internal loss multiplier. BI component multiplied by your internal loss multiplier, and that will give you operational risk capital. But what is this BI component and what is this internal loss multiplier? That's where the real work begins. This BI component is derived out of the percentage of the business indicator. Now, what is this business indicator? The business indicator is basically some number which is then adjusted for banks, which reflect their trading losses, operational expenses, and all the things that they have done, like their spending and basically the loss, the outflow part, right? That is giving you some kind of analytics, which we call it as business indicator. You take a percentage of it, we call it business indicator component, and this is used in the multiplication for the operational risk capital. So this is how it looks like. It is this multiplied by the internal loss, or rather I should keep it here. I should first change it to pink and should multiply it here. Okay. And now the second part, what is the ILM, internal loss multiplier? The multiplier that you're using is basically derived of the loss component. Now, what is the loss component? Loss component is a simple equation. It comes from a simple equation where 7x plus 7y is plus 5z gives you the loss component. Now, what is the loss component? 7x is average total annual losses is considered as X in your equation. The Y considers average annual losses which are greater than 10 million, and the Z component is average annual losses which are greater than 100 million. All losses 10 greater than 10 million and greater than 100 million. All these combined together gives you the loss component, which helps you come up with internal loss multiplier with this equation. With this equation, ILM is equal to ln exp1 minus plus sorry, this is 1 minus, right? Mm, minus 1, sorry. Minus 1 plus loss indicator by the PI component. Now, what happens really is that this loss indicator and BI component for an average bank can be equal to 1, which means my overall ILM can be equal to 1. If ILM becomes 1, then my business indicator component will be equal to the operational risk capital, which happens for an average bank, right? For a normal bank, this ILM can be 1 or around 1 because we would see both of these things matching each other. But realistically, how is it calculated is like this. Should you expect any questions around it? Basically, no. All you need to understand is that operational risk capital in this case is coming from BI component into ILM, and the ILM can be 1 for an average bank, which would ultimately lead you to business indicator BI component being equal to the operational risk capital. And this 7x, 7y, and 5z are basically an equation. You don't even need to remember it. Is basically helping you find out the loss component, which would somehow help you determine the ILM, right? This is more important from exam perspective. Only theoretically, no numerical will come whatsoever, but you just need to have this mind map in mind to understand how things are working in finding out this operational risk capital under the standardized measurement approach. Okay, then the next topic that we go on discussing is um, the loss distribution, my favorite, the loss distribution, uh, loss distribution. As we know, this distribution we briefly discussed about in last chapter, where we said it could look like this because that's how our losses look like, and it's not like a normal distribution. But the point here is, how do you come up with the loss distribution, especially the operational loss distribution, and there are two components to it. Okay, so in this case, when we are talking about operational loss distribution, that is where we have the frequency component and the severity component. The frequency component is basically taken care by the Poisson distribution, which we have studied in the FMP chapter, and the formula remains the same, which basically wherein we said that for a given time period, how many times a particular thing is happening was given by Poisson distribution. The second one is loss severity, which means, even if things are happening less or more frequently, what is the severity of it? So COVID happened once in 100 years, but it has huge severity. But when it comes to, let's say a smaller event, which is like, dengue, maybe, it keeps on happening multiple times in a year, keeps on spreading it, but it dies down. It was not, the severity was not so much. Like if I talk about a banya shop, when we talk about spillage, leakage of, let's say, juice packet in his shop, it's very, very common problem, right? Theft is a very common problem in business. But as long as people are stealing pens, it is not such a big problem. If they are stealing computers, that's a big problem. you know that is how you'll need to think about it. The severity matters. So even if people are stealing 100 pens, probably I don't think that there is so much need to put cameras at all the places. But if people start stealing TVs, people start stealing microwaves from the offices, computers from the offices, that is where it becomes more problem. So the severity of a loss is different from the frequency of a loss, and that is where, when combined together, it helps you identify for or come up with the loss distribution. So the severity, the loss severity is basically kind of you know modeled with this log normal distribution. So think of it, when you create an operational loss distribution, it is basically a summation, not summation, I would say it's basically combination of two different things, which is frequency and severity, which has been brought together, both following different distribution. One is following Poisson distribution, another is following log normal distribution. With log normal distribution, we have these formulas. Not so important. I found it in the book. That's where I'm writing it. Do you expect any questions around it? Honestly, no. So this is the formula that I got from the book. That is where I'm writing it, just to give you a sense of what the formula looks like. Otherwise, don't expect any question around it. The basic problem with the loss frequency is that this data can be found out internally. So this data is not sold. No one will tell in the like Deutsche Bank will not publish that how many pens its employees are stealing, or how many people are taking papers from the printers for their own homes, right? So these are very, very small things, and they can basically, that's where market data is not available. They'll have to find out the data themselves. So internal data is very, very important here. You don't have any external data vendors. But when it comes to severity, there are multiple internal as well as internal data can be combined with the external data. So if there is a trading loss, the traders went rogue. We just knew from our previous class that UBS, SocGen, many other banks saw the situation where traders went rogue. All this was reported in public domain. So it's easier to identify an external data, easier to have it on external data and combine it with your internal data to come up with a meaningful loss severity number. The basic problem is, even if we talk about internal data, it's not very easily available. It's hard to source. Even if we say that we can source it internally, it's not that easy to come by, right? External data vendors are also very few in that case. So data scarcity is the biggest challenge. And when you don't have a data, you create data. How do you create a data? By using Monte Carlo simulation. So think of it, with the Monte Carlo simulation, I'll first come up with the loss frequency, which would be a Poisson distribution. Then I'll come up with the loss severity, which would be a log normal distribution. Somehow combine it together with the Monte Carlo simulation to approach a log normal distribution. And that is how it really works. There are 4 steps: sample for Poisson to create number of loss events, log normal for loss size of these loss events, sum these loss sizes for the total losses, Process is continued for several iterations to continue with the Poisson loss distribution. That is how it is being formed. Now, one of the data limitations are a major factor which drives drives lesser growth in this operational loss distribution. Like, it's hard to measure. When market risk and credit risk are easier to measure, even for that matter liquidity risk, this operational risk component is hard to measure for anyone. This is because of the estimation procedure. Sometimes they come from the vendors who are doing estimations. Sometimes there are potential biases as well. A lot of vendors, because the thing is, no one in a regulator like Deutsche Bank will not come up and openly say that, my employees are stealing, maybe even laptops. They'll not come up and say that, but they will report it when people are stealing money. Got it. And even if people are stealing 100 rupees, they'll not tell it. But if people are stealing 100 million rupees, they will tell it. Okay. So the point here is, by this, what we mean is, even if data is externally available, people will only report it when the quantum of the loss is very huge, when there is a reputational risk involved. So think of it, the losses do exist on a smaller scale. Losses do exist, and but they're not kind of important enough to be reported by any bank so that it gets available by a third party. So that is one problem. And the other thing is that, you need to adjust for the size. If you remember, here we also discussed for a business indicator that we need to adjust for bank size trading losses even if something exists. Like, for example, the scam, the Nirav Modi scam, which was, I think, around 8,000 crore scam. Now it was absorbed gently because by PNB, because the balance sheet of the PNB was very huge. Had it happened, the same amount of loss would have happened to some of the smaller banks, maybe say Vijaya Bank, or if there is like even smaller bank, let's say Grameen Bank. Okay. So there is Grameen Bank or that Pune City Bank, whatever, that smaller banks that exist. Now, if the quantum of the loss for 8,000 crore would have happened with Grameen Bank, they would not have been surviving to this date. They would have gone bankrupt long back. But PNB was able to absorb this 8,000 crore fraud because they had a huge balance sheet. And now this 8,000 crore, what matters to PNB is the size of the balance sheet. So 8,000 crore, Grameen Bank will not be do it. So Grameen Bank is a very smaller bank compared to PNB. So the amount of losses that PNB has absorbed, that has to be also scaled down for Grameen Bank if I'm doing it for Grameen Bank. Okay. So think of it, a 10 million might not matter to money, but a 10 million to me matters a lot. Or rather for that matter, even 10,000 rupees. A 10,000 rupees loss matters to me a lot, but not to Ambani. What is the difference? He's also human, I'm also human. The difference is he has too much wealth, and 10,000 rupee loss is very small portion of his portfolio. Whereas for me, a 10,000 rupee loss is a very big portion of my portfolio. So compared, because he's also human, I'm also human. The point here is you should scale up or scale down your risk, adjust your risk appropriately to reflect the size of the bank that you've been talking about. And that is where, when they talk about Deutsche Bank saying 6 billion loss or 5 billion loss, and when we talk about, smaller banks, for example, for that matter, Vijaya Bank, we'll not be able to take 5 billion as a loss because their probably total assets and worth is not even 5 billion, right? So we'll need to come up with size adjustment, and that is where the size adjustment is done through this formula. Estimated loss for bank Y. If you have a targeted bank Y in mind, you should adjust for this. Observed estimated loss for bank Y is equal to observed loss for bank X, which comes from the vendor, which is a vendor provided data. It's bank's revenues which were provided from the vendor. Then the bank Y's revenue, and then you'll have to estimate for the losses using a multiplier, which is beta, which is mostly 0.23 as per book. If it is not given, use it and liberally use 0.23, right? Now let's solve a quick example for that. If an observed loss for bank Z, so market vendor is giving it everything for bank Z is 5 million. So the loss is for 5 million. It has 1 billion in revenue. What is the estimated loss size adjustment for bank Y? So you want it to be adjusted for bank Y, which now has a revenue of 2 million, right? So now the point is you were given 5 million loss for a bank which is having 1 billion as a revenue, which is 1000, right? And then you want to adjust it for what would be the estimate adjustment for bank Y, which is now 2000 crore revenue. And then there is this beta, which is 0.23. So 5 million multiplied by, or 5 multiplied by 2000 into 1000 into 0.23 is this amount, which is our loss, which is our complete loss being adjusted. So what we are saying essentially is that for bank Z and bank Y for that matter, a loss of 5 million for bank Z is equivalent to this 5.86 million loss for bank Y. Okay. Now we come to the next section, and this is basically for size adjustment only. So this was basically for any kind of size adjustment only. Now we come to the applying scenario analysis. Now what is a scenario analysis? Since operational capital cannot be like the data is not very liberally available, so we try to focus on scenarios. What happens if this happens? What happens? Like some of the risk is beyond your control, like earthquake. So what happens if earthquake happens and the building goes down, right? Then what would be the scenario? Will I be able to run my systems? Will I be able to do something about it? So on and so forth. And that is where scenario analysis, a lot of things, because you don't have a data crunch, you can't even think of how many scenarios can exist where operational loss may be a result. And that's where you come up with with a lot of scenario analysis to think of it. Like the companies, even before COVID and everything, the companies were have started to switch over for most of the employees to rely on the laptops, right? But not in the government departments. Government were still running on desktops. Now, when COVID happened, people were easily able to switch, especially the private employees, private company employees were easily able to switch from working from home kind of an environment, whereas the government employees were not. The government employees had a crunch because they never had simulated for any such exercise there where they expected something to go wrong on this scale, and that is for for a period of a good amount of period they had to basically either not go to office at all in the period of lockdown, and when the lockdown was kind of relaxed, they were the first to be called back, because was no way that even a back office employee in the government office can actually work from home. That was a major problem. So scenario analysis helps you proactively identify a lot of risks that exist around us and help you take a mitigating steps. Then there are operational risk management, because you don't have data. How do you look for a forward looking approach? So some of the approaches that we have is, first is called as RCSA, which is risk and control self assessment. Think of it, I don't know, I'm the CEO of a bank, but I don't know at a granular level what happens in the teller department, what happens in the a security locker department, what happens in other departments. So I know the business as such, but I don't know at a very granular level what kind of risk these guys are facing. So there is an RCSA which is floated every year by the risk team. Their job is, think of it like a big survey which is given to these teams managers. For all the tellers there would be one manager, for all the cashiers, for all the guys who are taking care of the lockers, there are certain different managers, and whose job is basically, you know they float this survey to these managers. The managers basically survey these guys and come up and identify the risk that exists. Give me 1 second, guys. Okay, so no problem. So then they identify the risk proactively. They call out the risk. So the assessment would be like, what are the kind of losses that you foresee? What are the kind of risks that you have in your department? How do you think you can mitigate for it? What would be the severity of it? What would be the frequency of it? And this is all kind of a survey, right? It is all like a broad survey, an open form, I would say, not like a survey, because survey still gives you like clickable buttons, but here we are talking about more descriptive write-up, and that is called as RCSA, where the managers self-identify the risk and the mitigation strategy, severity, and things like that, and that is passed on to the risk team on an annual basis, where the risk team then basically assesses what it can correct and what it cannot. So that is the risk and self control self assessment kind of a program which is run internally by any organization. Then there are these key risk indicators which are very very common. It is common across sales, it is common across deposits, it's common across anything for that matter for a banking operation, that they have KRIs that they continuously monitor to find out if anything is breaking or close to breaking. um, so on and so forth. Then we have allocating operational risk capital. How do you identify? So think of it, when the risk team basically gathers input via RCSA from different teams, they aggregate it. They aggregate it. Some of the risk, of course, nullifies. Offsetting is always a part of the game. Some of the risk gets offset, but majorly they come up with what is required on an organizational level. Um, to achieve a risk measurement and what is also doable, right? If I say that people will not be carrying out this mistake, person who's a cashier will not be um, you know will always be held responsible for even the last penny, and he can't make mistake. That would be wrong. He's dealing with money. Now we whatever machines we install then further bring it down, then can further bring down the rest. But if we say it would be a zero, that's hard to achieve. That's hard, really really hard to achieve, that he's basically held accountable to the last paisa. I would say yes, he can be accountable till about last 100 rupees, last 10 rupees maybe. I don't know how it happens for banks, but he can't be held responsible for the last rupee because he's dealing with the money all throughout the day, right? That is how it works for the different divisions. Now, when it comes to the risk capital, they get it approval from the bank and board, and then they get the requirement back. And based out of the board's approval and the budget that they get, that is where they start getting a mitigation step. For example, one person in the bank is saying, my documents, home loan documents got stolen, right? Why? Because they were kept in open. So he sends a request to the risk department via RCSA. RCSA goes to the board gives him money. So the risk team comes back to him. Now buy yourself a locker, or buy yourself a lock, and lock your files going forward so that your files are not stolen or destroyed by rats. So this is how things are. The operational risk capital, whatever the capital is provided, the risk management always divide it or allocate it on the basis of priority. Things which have higher impact and higher severity. Higher impact and higher severity. Higher severity, higher frequency are the ones which gets the most allocated budget out of it. Then we come to something which is called as the power law. A power law, unlike, and this is like a non-normal distribution. We know that the normal distribution looks like this. There is certain distribution that looks like this. This is called as a power law. Power law. Just like the way I can find out what is the area under the X, I can find it out here as well. What is the area under the X, right? Now, where is this law usually applicable? It is more applicable than the normal distribution, right? When we talk about, 90% of the income tax payers, or 90% of the income tax is collected from people earning, let's say 10 lakh and above. So I know for sure that 90% is accounting for only 10 lakh. So I know for sure that 90% of income tax is only done by 10% of the people. Rest is all this. So the curve does not look like a curve. It looks like this because that is the reality of it. 90% of the wealth, or 95% of the wealth or 99% of the wealth is owned by 1% of the people, right? 99% of the wealth is owned by 1% of the, which is the reality, which is the true picture of the world. And for all these cases, we come up with power law. So a power law distribution is an alternative form of a non-normal distribution. This is how it kind of looks like. This is how it kind of looks like, a power law distribution. Whereas a normal distribution would look like this, right? Whereas a normal distribution would look like this. It's not that I'm expecting you to solve for it. The formula for this in terms of probability is probability for any area lesser than x, which where we are talking about this, is going to be equal to k into x into minus alpha. Now this alpha is a kind of a constant. model parameters, and this is alpha, where alpha is the thickness of the tail. It's kind of a constant, and the parameter k. So, you don't need to get too much into it, but the point here is power law is a non-normal kind of a distribution which follows this kind of a formula. The formula won't be tested at all, which is giving you more sense, more realistic sense of, where 90% of the wealth is held by 10% of the people, so on and so forth. Wherein we are not talking about normality, we are not talking about equality in society and everything. Then we come to insurance. What is the role of insurance in safeguarding for these operational risks? First is, of course, this is a mitigation strategy that I can buy myself an insurance to cover for the operational risk. For example, your theft insurance, your fire insurance, your everything is kept by that manner, within that manner, as an insurance is covering for all those kind of risks. Now, what are the different aspects of it? There could be a moral hazard while you choose for your insurance. What is a moral hazard? Thinking of it that, moral hazard is a thing wherein I started behaving in a way which I won't do otherwise had I not known the insurance doesn't exist. Okay. So think of it. I know that I'm insured for, let's say, 5 crore rupees, right? If I know I'm insured for 5 crore rupees, then I start with, let's say, an adventure activity where I am driving at the rate of 200 kilometers per hour just because I know I'm insured. If something happens to me, that's okay. The insurance company will take care of it. But had I not known that, I would not do this nonsense decision. It happens with banks also. We studied this concept first in case of banks, where we said the banks are, if the banks are not responsible, they will do anything for that matter, right? Which way they would not do it otherwise. So they were giving out loans to people and everything, but not even properly checking the document had they not been properly accounted for. So banks के case में we discussed about banking deposit being safeguarded by the RBI in certain cases. In all the cases, in fact, if the losses are within like 6 lakhs, the RBI will refund you about that money. But if the bank goes down and if you have a deposit more than 6 lakhs, that is where it has gone. So this is the moral hazard. Moral hazard says that the tendency of any person or institution to behave in a manner knowing that it has insurance is different than what it would have done without insurance. That is moral hazard. And adverse selection is that we do not conduct a proper due diligence to account for all kind of risk and charging two people the same kind of premium with different kind of risk patterns and characteristics there. So any two areas, let's say one is a let's say I'm insuring two factories, right? One factory is a chemical factory, another factory is let's say one factory is a chemical factory, the other factory is a kind of laundry factory. Not even laundry, I would say it has a lot of water, maybe swimming pool club. Okay, not, but it doesn't come under factory, but something that has to do with water. Now we know a factory with a lot of water storage in it will actually have lesser loss in case of a fire because the water exists within the factory a lot, like tankers of water exist within the factory. So even if there is a case of a fire, the loss would still be very, very less structurally because a lot of tankers are there with water at any point of time. Whereas the same kind of fire breakout in the chemical factory, the losses would be far higher because chemicals expedite the rate at which the burning of the chemicals happen, and they cause a lot of problem while it burns. Um, so that is where these two things, just by looking at that they are factories and they have this same square feet area, there's some insurance companies charge them the same amount of insurance premium, which is what they are saying is wrong. That there are adverse selection. You're not able to clearly identify what is the high risk item or a low risk item, but end up charging the same premium to two people with a different kind of characteristics.